Hi everyone, this is Avnish from AssetPlus, and I'm very delighted to welcome Mr. Chaitanya Choksi, Fund Manager of JAM Financial Mutual Funds. He is a CFA and MMS in Finance from Mumbai University, and he has over 21 years of experience of fund management and equity research, and has also previously worked with Invesco, Chandrai Finance Private Limited, ILNFS Investment, and UTI Investment Advisory Services Limited. So over to you, Chaitanya sir, to take this forward.
Thanks a lot, Avnish. And as you all know, we have launched our Midcap Fund. And Avnish introduced me. I have been in JM since quite some time now. I've been in JM for the last 14 years. And, we have launched our Midcap Fund now. NFO opened on 31st of October, closes on 14th. And I just try and, focus on the key slides in the presentation, not go too much into detail, so that we get more time for Q&A. I'll just focus on the key slides. Hope that is okay. So, what are the things that I will be covering? Why India and why we are positive on India from a macro perspective? And why should we look at Indian mid-caps, and why should we look at them now in terms of timing, valuation, and what is the re-rating potential, and why you should look at our mid-cap fund, JM Mid-Cap Fund. So just very quickly, as you all know, we are the fastest growing major economy in the world. Our nominal GDP is almost touching $3.5 trillion. We are ranked quite high on various parameters. We have, a demographic dividend and the second largest labor force in the world. And I'll talk about this hockey stick impact of, what happens when our per capita GDP crosses this inflection point of $2,000. And, what we feel will be the impact of that. I'll talk about it in the subsequent slides. And on the chart, which basically talks about, how India has entered into a virtuous cycle. Our high GDP growth, and personal incomes leads to higher financial and physical savings, which feeds into higher taxation for the government, enabling them to, spend on infra and capital expenditure, and which again leads to higher incomes and higher consumption, which again feeds back into that high GDP and personal income growth. So the point is, our economy has entered into that virtuous cycle, and as compared to the vicious cycle of the past, when we used to do, in the 80s, when we used to talk about low GDP growth and low income levels. So quickly on the aspirational spending part. So the key theme for our presentation is that, India, after 75 years of independence, how our population, is moving from the stage of just, spending on their basic needs of roti, kapda, makan, to higher and higher aspirational consumption and higher and higher premium consumption. So, here in this slide, we've seen data for countries like, say, China and South Korea. And, you can see in China, they crossed their per capita GDP, numbers in 2006. And for 10 years after that, China's GDP grew at a CAGR of 14%. Similarly, in South Korea, they saw this inflection point in 1983, and for the next 10 years, their economy grew at a compounded rate of 15%. Now, this was mainly driven by consumption and investment. So now look at India. We have crossed this inflection point in fiscal year 22, and like what happened in China and South Korea, we feel that our per capita GDP and overall economic growth can be close to double digit, again driven by similar factors like consumption and investment. So the key point is, as our income levels keep going higher, we aspire for better and better products. So, for example, everyone wants to have, better smartphones and, better cars, better homes, better lifestyle. People want to spend on travel. People want to, eat at better restaurants, all those things. So the point is premiumization of consumption, higher discretionary consumption. That is something that we expect to happen in India over the next few years. The reason being now we have crossed this inflection point of, per capita GDP crossing that $2,000 mark, which leads to higher disposable income and higher aspirational consumption. That is the key theme of our whole presentation. So as you can see in this slide, the share of discretionary consumption in 2005 was just 15%, which moved to 24% in the year 2020, and which is projected to grow to 40% in the year 2030. So, overall income levels will go up, and within that, the spending on discretionary items will keep on increasing. Similarly, if you see the retail market size, right? So currently, around 40% of it, of the retail market is discretionary spending, and the remaining is on basic necessities. Now look at the number for 2022. Currently the retail market is at around $700 billion. So now look at the number for 2030. This 700 is going to move to around $1,300 billion. Key point is the share of discretionary will go up, which will be 50%. Now, if we see 50% of around 1,300, say around 650, that will be the size of just the discretionary spends in 2030, what we have of the total spends today, which is around 700 billion. So the key point is discretionary spending is going to go up. And finally, our e-commerce, how much of our purchases are on the online channel. Now we all know that data rates in India are the cheapest in the world, and even smartphone affordability has gone up significantly. Better and better features are available at cheaper and cheaper prices. So what this has led to the whole digital ecosystem being developed. And so what do I mean by this? We've seen things like in payments, and sort of change that has got about. We all saw the benefits of Jan Dhan, Aadhaar and mobile, which the government talked about, the JAM Trinity. Also, newer and newer business models got developed. Platforms like, say, Nykaa, right? So, for a customer in a tier 2, 3, 4 town, for them, access to beauty and personal care products now is equivalent to anywhere in even a metro. So they no longer need to, travel to a bigger town or a city to buy their, needs. And a lot of these is aspirational consumption, right? Better beauty products, fashion products. So the point is now, Nykaa doesn't have to open a store in those smaller cities, right? The customer can just order on the app, and he or she knows that that is going to get delivered with the comfort that this is a genuine product and at a discounted rate. So this is just one example of the digital ecosystem along with payments. And we all know how Amazon and Flipkart and how all those models have come about, right? So the key point is a lot of changes. We also had things like GST, demonetization, government talking about reducing logistics cost. So I can keep talking about all the factors and how all those have come together to drive the growth that we are seeing in our economy right now. And this is going to give further impetus to the growth going ahead. So point is, we are quite positive on the India growth story. And I spoke about consumption very briefly. I'll talk about the other aspects as well. So exports, right? Our share in global exports is just 2% at $400 billion. And, there is a lot of potential to grow our exports. We saw that China had their problems. The government tightened the environmental norms, because of which a lot of chemical sourcing happened from India subsequently. Now they have the zero COVID policy, right? So a lot of supply chain disruption happened. So, India is a major beneficiary of that. Even global companies, if you listen to managements of all these MNC companies like say ABB, Siemens, Cummins, they all want to outsource from India. They want to have an alternate to China. So we are benefiting. Government is providing incentives for that, in terms of reduced tax rates for new manufacturing companies, export incentives, even the PLI schemes you all are aware about. So all of this is leading to that big change, and these are the pillars of growth for our country. Finally, savings, right? You all know much better, how the flows to mutual funds have been over the last few years, especially post-COVID, and the sort of retail participation and overall participation in the markets. So that is huge, right? And that is leading to, things like from last October, FIIs have sold more than $50 billion in our markets, which has been absorbed by the local, domestic mutual funds. So just imagine a similar situation in 2008, such sort of FI selling, which is what we saw. There was no domestic support that time, right? Now, something similar today happens without the domestic support, our markets would have been much weaker than where we are right now. So investors have matured. There is a lot of maturity. Overall, things are improving. We are on the right track, and we are quite positive for the next 5 to 10 years. Just quickly on the current global macros, we all know how inflation has moved in the Western economies, and the reasons are also well known. But the key point is, their economies, the inflation levels were always in that 2, 3, 4% band, right? And just see post-COVID how it has moved. Now they are at around 8, 9, 10%, right? So that's a huge change for them. Now compare it with India. We have always seen, levels of 7, 8% inflation is not new for us, and we have seen such levels in the past. So a lot of factors led to this spike in inflation. Like a lot of monetary and fiscal stimulus was given by these Western economies, and then US, sort of free money was being distributed to the citizens as a measure to support them, post COVID and because of the lockdowns. All that, along with the recent the Russia-Ukraine war, and the supply chain disruption in China. So all these things have come together and led to this huge spike in inflation. India is much better off. We feel that the inflation has sort of peaked out for us, and to that extent we are much better off. Even on terms of GDP growth, I mentioned that India is one of the fastest growing economies. You look at how the economic growth for the Western economies post-COVID, everyone saw a fall, and everyone recovered because of the low base. But subsequently, their economies have, they're sort of trending down. Now look at India. We are much better off, right? Now people are talking about probability of recession in the Western countries. Some estimates say it's as high as 100% for the US next year, whereas probability of a recession in India, we are very confident it's 0. Just a few numbers. I'm not going into too much detail here, but this is the sort of fiscal deficit to GDP, how they moved in, these Western countries as compared to India. India also had to give a stimulus, but we did not go all out on giving, supporting our economy. The government did the right thing. They did targeted, stimulus like the food subsidy scheme and, some incentives for SMEs and all. But net, the sort of fiscal deficit that you see for other countries, say for US, their fiscal deficit moved from 4.7% pre-COVID and to 15% because of the COVID easing. Similarly, UK 2.2 to 12.4. Now, look at the monetary policy rates, right? What a sort of rate cuts they had to do. US went to 0 post-COVID. UK went down to as low as 0.1. India also, we also 115 bips. We went down to 4%. Now, because of the inflation I spoke about in the previous slide, the tightening has, to control inflation, they have started hiking rates. Now, this is as per last month end, but now already US has hiked by 375 bips. UK is on that same path. But India, for us to get to our target rate of 6% is, from where we are, is going to, the number of rate hikes we will need will be much lower and the quantum will be lower compared to US. From 8%, they have to go to their target rate of 2%. So net, our macros are much better off, and the growth is in our country, and that's why we are very positive. Coming to why midcaps, some of the things that don't, I would highlight some of these key slides. Now, this on the left, we have given data on the sectoral composition of the Dow Jones Index, compared it with the sectoral composition of NSE Midcap and that of Nifty 50. Now, when we look at this, this data, visually we can see that the sectoral breakup of the Dow Jones and NSE Midcap is quite similar versus to the Nifty 50. So, point is, Dow Jones is a mature index. Whichever companies have grown in the past, they have become members of the Dow Jones, right? So, if I want to play for growth of the future, which sectors and, where can I take that exposure? So, it's looking at this data, it's quite clear that today's midcap index, NSE midcap, is, if we want to play for the future growth and sectors which will migrate to the large cap index, midcap is where the opportunities lie. I will give some numbers here, right? I spoke about discretionary spending. If I want to play that theme, where will I get higher exposure? Look at Dow Jones. The weight of consumer discretionary is 13.5%, 17% in NSE midcap, whereas it's just 7% in Nifty 50. Similarly, industrials, another theme that I highlighted, 14% in Dow Jones, 18% in midcap, whereas it's just 3.8% in Nifty. So if I want to play for the future growth and, where will I be able to take higher exposure? It's clearly in the midcap index, as this data highlights. Similarly, something like healthcare, Dow Jones is 20%, midcap is 9%, whereas Nifty is just 4%. So as the population ages, more and more healthcare needs will go up. The diagnostics cost will go up, the medical hospitalization cost, the medicine cost. So all that is, if I want to play that theme, I'll get much more exposure in the midcap index. So we just saw the data, NSE midcap, the number of sectors is 19, whereas in Nifty 50, the number of sectors is 14. So much better diversification and higher weight in sectors where we are positive on and where the future growth lies. Again, last thing on this slide, look at weight of financials. It is at 36% in the Nifty, whereas it's just 16% in Dow Jones, and again 16% in midcap. So clearly this weight of financials in the Nifty will go down, and a lot of these sectors which I spoke about are the leaders of the future. They will gain share and be a part of the large cap index subsequently. Okay. So one more thing on midcaps, earlier there was this perception that in a rising rate environment, because of high debt levels, their interest costs will go up and the profitability will come down. So we did some data crunching on, where the midcaps are currently placed. Now we look at the data, NSE midcap 150, net debt to equity. In 2016, it was 0.57. It has come down to 0.27 now. It is halved from there. Now, why has this happened? Now, a lot of capacity was created in the earlier phase of, capex cycle. It went unutilized, right? Because demand didn't come by, and their utilizations dropped. They used these cash flows for repaying the debt. So over the years, they've been doing that. So look at the absolute debt numbers, right? That is also coming down from 2 lakh crores to 1.5 lakh crores. Even profitability of midcaps, overall profitability, it has doubled from around 50,000 crores to almost 1 lakh crores. So that's the sort of profitability they have now. So key point is the balance sheet strength of mid-caps today is much better than it was a few years back. And the next phase of capex cycle, that the concern should not be there. How will they fund that capex, and whether their leverage on the balance sheet will go up significantly. Now, this is again some interesting data. We looked at the top 10 performers of the mid-cap index and compared them with the top 10 performers of the large cap index. Now, key point is just see the multi-bagger returns that the top performing mid caps have given versus the top performing large caps. So the key point is, if we are able to identify the right stock and the right sector at the right time, the sort of multi-bagger returns when, if we are able to identify them in the journey of when they are mid-cap, small to mid to large, that's the time the best compounding of returns happens. Even large caps have appreciated, no doubt, but the key point is just see the multiple times of returns that, the top performing mid caps have given. So the key point is the power of compounding. The real alpha generation happens in mid caps. Again, some data. So you all would remember that SEBI did this reclassification exercise sometime in 2018 of what is a small cap, mid cap, large cap. So we thought, why not let's compare the returns of stocks which have migrated to large cap. What were their returns 10 years before they migrated to large cap, and what are the returns after becoming large cap? So clearly, you see we have taken December 2012 as the base. So clearly the sort of returns that they had when they were in their mid-cap journey is much higher than what returns they gave once they progressed to the large cap category. Now, obviously, because the time period is much higher in the mid-cap journey. So, but the point is the level of returns that they gave, when 10 years before they became large cap and subsequently after becoming large cap. So again, the point I am stressing that right time, if we are able to identify the right stock and sector, the alpha generation and compounding potential is huge. Again, I was saying of which sectors will drive the growth in the future, right? So it's going to be all these newer sectors, right? Online broking or quick service restaurants, app-based aggregators. I spoke about Nika. Some of the other themes that we are positive on, this whole equity participation of our population. Now, today's generation, I guess they don't invest in gold and real estate, right? They want to put their money into the equity market, mutual funds. So as the population also prefers that, if I want to play on that theme, say asset management companies, financial market infrastructure companies like say CDSL, CAMS, all of them are going to be available in the small and mid cap space. We are not going to be getting too many options in the large cap space. And so newer and newer companies and sectors will come up for listing. Now, we did some data. We saw the data last 3 years, 280 IPOs have come, out of which 271 were in the small and mid cap space. It was across sectors which we have given, all the data. Key point is, again, a lot of diversity of growth, and the opportunity to play that growth is going to be in the small and mid cap segment. This data clearly shows that across any time period, the returns in mid caps have been higher than large caps. Clearly, I don't need to say anything. The data speaks for itself. And over longer term, the sort of alpha generation in mid caps have been higher. We were seeing the data for mid caps. The mid cap index itself in the last 10 years has gone up by 16%. Nifty index has compounded by around 13.5%. Small cap has compounded at around 15%, and BSE 500 at around 14%. And mid cap funds, as compared to 16% in the mid cap index, mid cap funds have compounded at 18%. So that's even higher than the index level, index numbers. Again, there is this perception that mid caps tend to be more volatile. So again, data here, standard deviation, which is a measure of volatility. Even though on a 1-year basis, the number does look a bit higher, but over longer periods of time, the standard deviation of mid-cap index is not too different from the large cap index. So this perception also does not actually hold true. Similarly, there is the perception that they tend to be more risky. So we saw the data on the Sharpe ratio, which is a measure of risk-adjusted return. How much return is being generated for every unit of risk. So again, clearly this data again highlights that the returns have been better. The returns have been better even on a risk-adjusted basis. The Sharpe ratios are better for the mid-cap index. So again, that perception actually does not hold true. Why should we look at mid-caps now? So another feeling in the market is that valuations have gone up significantly, whether we should invest at this point in time. So this chart gives the forward P multiple of the mid-cap index. So 12-month forward P multiple. So we know that in 2017-18, there was a huge rally in small and mid-caps. And mid-caps in particular here, their forward P number went up to almost 23 times on a forward basis. Post the COVID correction, it did correct to levels of around 11 to 12. And in the sharp recovery post-COVID, it again went back to that around 23, 24 times. Now, the point we are trying to highlight is they're just above their long-term averages. It's not as if, the valuations are too rich. They are higher, but just above long-term averages. Now, point is we've seen some time consolidation in the markets. At the same time, earnings have also grown. So from here on, we feel that we are entering into a new phase of P expansion. Now, across periods of time, we've seen, the periods of markets, periods of peak expansion and contraction. This is on a trailing 12-month basis. So from the current juncture, we feel that we have entered into an expansion phase because of the factors I highlighted, and earnings will grow. Our economy is well placed, and because of the factors I spoke about. Why you should look at our fund? Now, Satish is the fund manager for this mid-cap fund, and I'm the co-fund manager. And Satish, as you all know, has a long track record in the market, so more than 30 years of experience. He was earlier with Franklin Templeton and Sundaram Mutual Fund, and he has a long track record in the mid-cap space. Along with Satish, the other members of the team, myself and Asit Bhandarkar, we are the fund managers. Me and Asit, we both have been in JM mutual funds since the last 15 years, and we have been, been a part of this team for a long time. Along with that, we have our research colleagues, who also have significant number of years of WorkX. Myself and Asit, we have been in markets for more than 20 years now. Even our research colleagues, they also have a good experience in the markets, around 15 years. And so collectively as a team, we've seen different phases of the market, that global financial crisis, the taper tantrum, the COVID fall. We've seen various phases of the market. So this we feel does help us to, take better investment decisions in terms of what phase of the market, what we should look at, and in terms of the softer aspects of analysis, right? Like our knowledge of managements, of sectors, of what managements have done in the past, have they executed well on strategy, what are the levels of corporate governance. So this we feel does help us to take better informed decisions. Along with this, I'll talk about our research process and our the risk management. Just very quickly on how we plan to construct our mid-cap portfolio. Now, a bulk of the portfolio would be on consistent growth stories. We will hold them for at least 4 to 5 years. We look at structural growth potential in any stock and sector. and the typical holding period will be 4 to 5 years. Again, with corporate governance and capital efficiency. Here we will be sector agnostic, and whichever sector we find that potential, we will buy there. Second bucket is fallen angels, which will be at around 15% of our portfolio. Here, a lot of businesses face temporary issues, right? Maybe a cyclical sector or, some temporary business issues. We will look at such stocks. Allocation would be around 15%. Holding period would be 2 to 3 years. And we would give it some time for the fundamental business factors to turn around and the re-rating to happen. Lastly, jewels in the sand, low priority for us. Very event-based, short-term, specific situations. We will have a look, but that will not be a focus area. Now, risk management is something we lay very strong emphasis on. So, for on those lines, we have defined our guardrails, what we will follow in the fund. So, things like we will have minimum 30 to maximum 50 stocks in the portfolio. 50 is also on the higher side. Ideally, we feel that 35 to 40 stocks is the ideal number in terms of diversification. Top 10 holdings will not cross 50% of the overall portfolio. Maximum weight per stock will not be more than 7.5%. Minimum weight per stock will be at 1%, and cash limit will be less than 10%. So normally we don't take cash calls. We feel that investor, as part of allocation, his asset allocation has given money for equity. So, it should be fully deployed. But cash levels will maybe at any point in time will not go to this 10% number. Maybe it may go to say around 5 to 6%, depending on our view on the market. Also, we have defined what sort of exposure we'll have on a sectoral basis and how much will we deviate from the benchmark. So, for example, if a sector has a 10% weight in the benchmark, we will not deviate more than 25%. So, our weight will not exceed 12.5%. Similarly, we have defined it for other levels of benchmark weight. And finally, in terms of exposure limits, since it's a mid-cap fund, as per SEBI definition, we will have minimum 65% in mid-caps, and the remaining 35% can be in small, mid, or large, but our preference will be in the small and mid-cap segment for the remaining 35%. Just a few, on our geek model, which is something which we follow and have been following for a long time. Now, growth of earnings and earnings quality, those are the key pillars of our investment philosophy. And, that's what we have followed rigorously for our portfolio, construction. So growth of earnings. So what do we mean by that, right? So opportunity size growth. Now, how do we define opportunity size? So, I give example of Titan, right? So their Tanishq chain of jewelry stores, they are present in the jewelry retailing market. Now, we all know the jewelry retailing market, say 25 to 30 years back, a lot of it was unorganized. There were, all the neighborhood jewelry shops and a lot of issues in terms of purity and, customer service. This is the model which has succeeded. More and more organized chains coming in, national chains of jewelry. You have Tanishq, you have Malabar, you have Tribhuvandas, Bhimji, and the likes, Kalyan Jewelers. Now, organized market today is at 30%. Still, there is a long runway of growth. We still feel that, organized will keep gaining share there. So this is an example of opportunity size growth. We do hold Titan in our portfolio for a long time. We continue to hold it. Along with that, there are factors like EPS growth, price earning to growth ratio, other parameters which we have, I'll talk about briefly in the next slide, and also the corporate governance and quality of management is something that we are very particular about. I request you all to go through our existing portfolio and portfolio holdings for the last 10 years, and I don't think there will be any issues in terms of the quality of the companies and the overall managements of these companies. On just quick quickly on numbers, our portfolio parameters. ROE should be more than 15%, earnings growth more than 15%, return on capital more than 15%, debt to equity should be less than 1, and operating cash flow to EBITDA should be more than 65%. We have tested our existing portfolios on these parameters, and they are in line with this. So around 80% of our portfolio will meet these parameters, and the remaining ones we can look at any particular opportunities where we feel that even though they are not meeting these parameters at the point of investment, once the re-rating happens, they will be in line with what we want to achieve. This again, just one quickly on the research process. One particular point I want to highlight, apart from company meeting managements, something very important for us is meeting this domain experts. Now, every industry has experts, right? And we meet them during conferences organized by our brokers. And this does give us very good insights into what's happening in the industry. And they tend to give a very neutral view and what's actually happening, rather than managements always tend to be more optimistic on their sector and their company. So meeting these domain experts does give a very good perspective on what's actually happening, and it helps us in better analysis and better investment thought process. This again I will skip. Just a couple of minutes on this slide, which is again very important for us. So every week we do an attribution analysis. Now, where we see that how are we performing, how is our portfolio performing versus the benchmark, how is it, what is contributing to returns, what is leading to negative returns for us. So whatever is contributing, should we hold on to that, or should we trim exposure, get out of it? And if something is not working, then we question ourselves, should we continue to hold this? And so the point is that it helps us continuously question ourselves and our investment thought process, and this has helped us in refining our process, and over the years it has helped us in taking better investment decisions, and as a result of this exercise we are able to reallocate our portfolio holdings in terms of sectors and stocks. This is all a part of risk mitigation, and this is something which has actually helped us quite a bit in the past, quite a bit. Finally, just a few quick slides on what has worked for us in the past. So this is actually the stock is Trent Limited. We all know how the website model, they have done a very good job at it. Even the Zudio model which they have come up with in the fast fashion category, that is also doing really well. We've made very good returns here in the last 3 to 4 years. We continue to hold the stock. Very good company, very good execution, and the management is Tata. So again, no doubt on that. This stock is SKF India, and we have been holding this stock for a long period of time, and we've made very good returns here. And again, MNC management, beneficiary of industrial and consumption through autos, and stock continues to do well, and we continue to hold it in the portfolio. Finally, this stock is CDSL. We got into it mainly as a play on increasing retail participation in the market, and better, say demat account openings. They are the market leaders in that. Luckily for us, after buying this, COVID hit, and we all know how market volumes went up. So we made very good returns, and we did exit the stock because at some point we felt that valuations are not in sync with what the growth is that is going to come from that level. So we did exit the stock, fortunately at the right time, and subsequently it has corrected, but we will have a relook once we get comfort on valuations and growth, what price we are paying for that growth. So I think I'll end here, and thanks a lot everyone for listening to me patiently. I did try to quicken the process of the my actual presentation. I wanted to give more time for the Q&A. I hope I've been able to convey our thought process on our fund and our philosophy, and why we are positive on India. And very happy to take questions now. Thank you.
I think I have a couple of questions which I have received, but I think Surendra also has some questions. I'll also allow the participants to unmute themselves so they can ask questions.
Yeah, if you can help me, I'm not reading them through the chat box. If you can read them out, it will be great.
Sure. I have allowed participants to unmute themselves. They can ask questions if they have any, and then we'll take up the questions which I have received on chat.
Great, thanks.
Hi Chaitanya, I have a question.
Hi.
So like with central banks all over the world are raising the interest rates, won't the mid-cap companies struggle to generate profits? Like as their cost of borrowing would become high compared to a large cap company. So initially it would be a big task, right?
You think that is a concern, right?
Yeah.
No, in fact, I highlighted on this point in my presentation, how the debt to equity ratios and cash flows of the mid-cap companies, how it has improved over the last few years because the sort of deleveraging which has happened, right? In this particular slide, I highlighted that their net debt to equity ratios have come down significantly, over the last few years because of the very good cash generation that they have seen and the absolute profitability which has gone up. So this concern was there, no doubt, in earlier times, in times of rising interest rates. This was a very valid concern. But as of now, as of today, because of the deleveraging which has happened in the balance sheets of corporate India in general and mid caps in particular, we feel that it's not a concern because the balance sheet strength is very good and they are very well poised to invest for the next leg of growth, considering that the capacity utilization levels are already hitting 75%. We are going to see a renewed phase of capex, and the ability to fund that capex, these companies are in a very comfortable position. So I did speak about that in this slide.
Okay, I have one more question related to the geek model. Like
Yes.
you told about that, James would be focusing more on the cash flow rich companies. So, but certain companies, even though with debt, they try to grow aggressively, right? For example, certain high debt companies grow big. So, won't there be a miss of lack of opportunity that you might miss if at all you just focus only on cash flow rich companies?
No, you're right. There would be companies, who would be doing aggressive expansion and leveraging the balance sheet, right? But we have other filters as well, in terms of, what has been the track record of the management in the past. And, this is something also which I said that collectively as a team, we feel that our ability to take a call on whether the capex that company is doing, whether the execution of that capex will be beneficial, and secondly, the outlook on that sector itself, right? Now, we all know companies which will be expanding right now, and we have outlined which sectors we feel the growth is going to come from. And along with these filters and our comfort on the management, there are enough opportunities available, right? And the number of small and mid cap companies today, right? The sheer diversity of options available, good quality companies, good managements, that basket is increasing. So I don't think, in fact, I think the problem is going to be what to select in the basket, because the number itself is so, the choice is going to be very good. I also highlighted the IPOs which are coming, right? And the diversity of sectors and companies in that, the newer sectors which are getting listed, and And the growth is going to come from number of sectors. We've highlighted some in this slide, but newer and newer ways of doing things. And, there are so many examples, but I don't think that's a concern at all. In fact, it's going to be a problem of plenty, I feel.
Thank you, Chaitanya. I got it.
So if anyone has any other questions, you can please unmute and ask. I'll just wait 5 more seconds.
Yeah, I have one question. See, one aspect I have understood, if a fund is both large and mid cap, then the fund manager can actually, ensure there won't be any liquidity constraints if they're purchasing any mid cap and balance with large cap. But if it is a pure mid cap play, based on the fund size and variation, is there any liquidity point of view issues will be there or not in that space? Suppose if you are like operating in both mid cap and small cap because of the restrictions.
I agree. I get your point, but with the development of the markets and the size of companies, I just want to highlight one point. As per SEBI categorization today, it's as per market cap, right? Top 100 companies in terms of market cap. So the market cap of the stock number 100 having the highest market cap is 47,000 crores. The market cap of the mid cap, 101 to 250 is mid cap. What is the market cap of the stock having rank 250, right? Who is the last mid cap? That is 17,000 crores. Now, the definition itself has changed, considering the levels we are at the size of companies. Now, you compare this number to say 10 years back. Now, what we used to define as mid cap was something like a 5, 7, 10,000 crore company, right? 10,000 is also on the higher side. So liquidity will not be an issue, especially considering, the diversity of choice. So, anything between 17,000 crores and 47,000 crores is mid cap, and anything below 17,000 is small cap. Now, even a 10,000, 15,000 crore company today is classified as small cap. So I don't think that is going to be an issue in terms of liquidity. Yes, there might be stock-specific cases where the market cap is lower and the free float is also lower. There can be issues, but on an overall portfolio basis, I don't think that should be an issue, especially for the smaller size schemes in terms of AUM. Maybe the larger ones would have that issue because considering the size they have, larger funds with larger AUMs will probably have faced that issue. But I think the smaller funds do face an advantage to that extent, because for them to maneuver between small, mid and large, depending on the category of the fund, is much better and the impact cost is much lower. So the short answer to your question and my long answer, to put in short, I don't think that's an issue.
Okay, thank you.
All right. So there are actually a lot of questions from Raj, but I think the number of one question which is asked is that some clients are hesitant to invest in NFO due to no track record. How should we deal with them? And what is the exit strategy for a stock that has entered the portfolio?
Right. So to answer your first question, I assume he means by JM's track record, right, in Midcap Fund?
Yeah, we can assume that.
Yeah, okay, fine. So I would request you to have a look at the long-term performance of our existing schemes and the track record that we have built in our existing schemes and the quality of the portfolio. And so, for example, JM Flexi Cap is something that we are, think quite aggressively, along with, some other funds like, say, Tax Gain Fund. Again, you can look at the long-term track record. I think there we do have a track record. And we will follow a similar process of what we have been doing in those funds for our mid-cap fund in terms of all the parameters that we look at and the filters. And secondly, even our other schemes, like our focus fund and large cap fund, we have done some restructuring there. So focus fund was earlier just 11 stock portfolio. It did very well in between, but last 2-3 years there was some, it was a 11 stock portfolio, which we at some point, the performance started getting impacted because of the concentrated nature of that scheme. So we restructured that scheme and made it a focus fund of up to 30 stocks. Post restructuring, the performance has improved significantly over the last 1 year. Similarly, for large cap, again, we have restructured that scheme, and the performance post restructuring has been quite good. So to answer that question, I would suggest that you have a look at our long-term track record for existing schemes. And the methodology and thought process and philosophy that we will follow for our mid-cap fund will be on those same lines. Plus, as I said, in terms of experience of the team and ability to, manage the funds, we spoke about Satish. He has been in the market for 30 years, along with the other team members. And I think that should not be an issue in terms of track record. And sorry, what was the second question?
So he was wanting to know what is the exit strategy for a stock.
Okay, exit strategy. Fine, got it. Yeah, so I gave one example, right? There was, I spoke about CDSL. So there, the stock did really well, and we all know, thought that at one point the valuation band and the actual multiple had gone up significantly. We took a call to exit because we thought that the current prices don't justify the growth that is going to come ahead. Having said that, we will have a relook at the right price. We've had such, we have many portfolio holdings which we held for a long period of time, but we exited. I'll just take a few names since, it will help put my point across better. We have exited stocks like, say, Eicher Motors, which we held for more than 10 years. We have exited stocks like Bajaj Finance and Finserv. Again, we had a very long-term holding there. So, when will we exit? When the valuation does not justify the growth that we expect going ahead. For example, Bajaj Finance, they used to guide for 25% growth and deliver 40% or higher. Now as the base has kept going up, for them to grow at a similar level is going to be difficult. So, but the valuation multiples continue to be the same. So we thought that the price does not justify, the growth. So that is a key metric, which we look at for exit. So I think I have highlighted the key parameters. Or if there is some corporate event, we have some doubt on the corporate governance. Again, I will, there was a property developer, a very well-respected property developer. Now, I will not name it, but they did have some, had a tie-up with another developer, and we were, again, this stock we were holding for a long time, but we took a call that in terms of corporate governance, we don't like what they did, so we just exited the stock. So any of these things, or where the future outlook in terms of the industry itself, it does not give us comfort in terms of the growth outlook for that particular sector. So yeah, I think these are some of the key parameters which we will consider to exit a stock.
All right, I'll take up one more question. I think, do you have time for that?
Yeah, please.
Great. So there's one more question which is being asked by Rajneesh, sir. The question is, what is the stock selection methodology which will be followed in JM's Midcap value growth, say, for example?
So, as a fund house, we are growth oriented without a doubt. India is a growth economy, and there are a lot of opportunities to this growth story of our country. Our fund will be primarily growth oriented. Maybe in between we may look at value stocks, maybe looking at the point of the market we are in, in what phase of the market we are in. If we feel valuations of these growth stocks have gone out of sync, we will look at value stocks to some extent, but it will primarily be a growth oriented fund, because we feel, India is a growth economy and there will be phases of value outperformance, but I think over longer periods of time, growth will outperform for sure.
All right. And there is one more question from Srihari. This portfolio matrix is for how many years past performance of a stock?
So we have evaluated these our existing. See, the metrics, historical numbers will match, but the exercise we do is that my portfolio holdings as of today, based on estimates, we look at Bloomberg estimates. So that does give us what is the next 3 years projection for those stocks. So, based on today's, where we are in the market and in terms of financials of that company, based on projections for the next 3 years, how is this going to look like? So, for example, ROE of a stock may not be at 15% today, but if I'm positive about the outlook and that's on that stock, if I feel that the margins are going to increase, if it is say even a 7-8% ROE company today, but in my projection, I see that after 3 years, this ROE number will move to 20%, right? I will buy it. It's not as if it has to be 15% on day one. When does the re-rating happen? When the financials actually start, showing better numbers. So that's when the better returns are made before you, actually see the turnaround in any stock or a sector, or when you are in the starting phase of the growth of that stock or sector. So the point is that we look at 3-year numbers, how is the numbers looking on a portfolio level. This data does come on Bloomberg and they have their estimates on all these parameters. We also have a research team in-house. Bloomberg does have their numbers. We also have our internal estimates based on our analyst estimates. So, a lot of times consensus numbers can go wrong. We have seen that a lot of downgrades keep happening, but we do have our internal numbers as well to, take a view on those numbers as well. So, answer is 3 years at least we look at in terms of future numbers.
Great. Thank you so much. There are 2 more questions. Should I ask them as well?
Yeah, please ask. I have time.
One question is, how much could be the drawdown if we invest in JM Midcap? What is the risk management strategy of the fund? Have we answered this already?
I think so. I've taken up risk management quite in some detail. Mm-hmm. But anyway, so drawdown is something, it's difficult for me to say because it all depends on the market, right? Now, our endeavor would be if the market corrects, like market can correct any time and at any point in time and for any reason, right? Now, the risk in the market is actually from something we don't know anything about. COVID is a very great example. So who could have imagined COVID hitting us, and the world going into lockdown? We saw the drawdown which happened, right? Now, point is we will try to build portfolios which everything will fall, no doubt. But when the market recovers, our stock should, first of all, because of the quality of the management and, their overall balance sheet strength, we have seen that the better performing stocks tend to fall less than the fundamentally weak companies. So secondly, they should, ideally fall less. And when the recovery happens, they'll be the first to bounce back. So we've seen this in the past across, various cycles of the market. Though we haven't seen any major correction recently, and actual quality of a stock does come out in a real correction. I don't think we've had a real correction, and many of the new investors have seen a real correction till now. But we have seen that when an actual, deep correction happens, the stronger companies are well placed without a doubt, and quality helps at those times. Similarly, so drawdown can be, I cannot give a number because I don't know, no one knows. But when it happens, I'm sure our portfolios will be better placed to face those challenges and come out of them better. So that's the short answer I can give. Not that short though.
Great. So there are no more questions on this, Chaitanya sir. So we can, if you have any parting thoughts, you can just voice them out.
No, so just to conclude from our end, this is our first NFO after a long period of time from JM, and this is something we all are working very hard for. We have already started our internal model portfolios of what will our portfolio look like. We are already brainstorming on the inclusions on what we will buy. A lot of effort going in there. But yes, we will stick to our parameters, and you all can have a look at our existing portfolios and how they have done. So this should give you some comfort on our stock selection and performance, and risk-adjusted returns. I suggest you all look at that as well. So yeah, looking forward to your support, and anything related to the fund, you can always get in touch with us. We would be very happy to answer. So on that note, thanks a lot everyone for listening to me, and hope to have your support for the NFO. Thank you very much.
Thank you so much, sir, for joining. Thank you, everyone.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.